AI is a driving force between a lot of this technology and a lot of these companies that we're going to be talking about today.
It's growing at 22 to 19% over the next 3 years. So this is a pick that I like today.
Look, I think it's frothy, but I think there's some great opportunities.
I've learned over the years when a company like this sells off, ignore the short-term threats and just buy the shares.
If it weren't for this one asset class that I'm going to talk about next, there would be no Nvidia, there would be no OpenAI. Hello everyone, it's Brad Thomas and welcome back to the Wide Moat Show. I'm joined today with my co-host Nicholas Ward. Nick, it's good to see you today.
Yeah, good to see you, Brad, and welcome to everybody. I guess, Brad, I'll eat a little crow here to start. I think I jinxed us last week. I said that would be the video that would get us to our 10,000 subs. I think we're about 50 short. So sorry everybody for postponing that celebration for a week. But please like and subscribe to this video, and then Brad and I will have our 10,000 milestone next Thursday.
Yeah, it's good probability. I'll just make sure all of my kids tune in, and we'll definitely push this over the hurdle here. And thank you everyone for watching today. And Nick, I got to ask you though, I know we didn't win the 10,000 yet, but I've got to ask you this week, how did we do with the football game?
We were 0 for 2 this week. No 10,000 subs, no victory on Friday for my high school football team that I coach. We played another single wing team. So this season we're 3-0 against teams that run traditional offenses, and we're 0-2 against teams that run single wing. So we can't figure out that offense. Need to get in the weight room, probably a little more in the off season, get our pad level down a little bit more. But thankfully there's only one more team on our schedule that runs that type of offense. So I think, I'm thinking 6-4, 7-3, we could still have a pretty good season, but we're struggling to stop the single wing this year.
All right. Well, we've got some winning picks here today. And of course,
there you go.
Nick and I spoke earlier. Today, we're going to focus on technology. And normally Nick will wear a really bright colored jacket, but not today. But we are going to focus on technology. And we're going to start, Nick, with Nick's technology picks. Yeah,
well, Brad, do you want to discuss the AMD deal? We're recording this on Monday morning. I know it won't come out till Thursday, but there's big news in the stock market this morning. So let's start with that, and then we'll get into the picks for this week.
Yeah, I was just reading through some research reports, and you're right. There's some news this morning that AMD, the world's largest CPU and GPU maker, and OpenAI, the firm behind the ChatGPT, they jointly announced a new partnership that will see AMD's Instinct AI GPUs power next-gen OpenAI infrastructure to the tune of 6 gigawatts. Now, the market really liked this reaction with this news today. I've got a screenshot here. And Nick, you're right. This went out on Monday, and we're going to be publishing Thursday. But as of now, today, October the 6th at 1 o'clock, AMD stock price is up roughly 28% from Friday. So definitely some market news. Now, remember, just a couple of weeks ago, there was another announcement made between Nvidia and OpenAI, another joint announcement, a very similar deal with AMD. This partnership involves the deployment of at least 10 gigawatts of Nvidia AI GPUs to help run OpenAI's next generation infrastructure. So obviously incredible demand, insatiable demand with technology. Obviously AI is a driving force between a lot of this technology and a lot of these companies that we're going to be talking about today, whether they're technology-based or technology real estate based, which is what I'm going to be talking about.
Yeah. So this has some people kind of worried about an AI bubble. It's interesting. I guess the main difference between the Nvidia deal and the AMD deal is AMD uses stock. So they are, if OpenAI builds, I think every gigawatt of data centers that they build, they'll receive some AMD stock. Nvidia actually had the cash to pay. So I did like the Nvidia deal more. They're a stronger company, I think. They have the balance sheet to kind of do whatever they want to do. But some people are worried about these kind of cyclical trades. Nvidia gives OpenAI, $100 billion, whatever it was, and then they just buy $100 billion worth of chips. So it's like really no money's changing. It's just like it's good press for the AI movement, but it's interesting to see if this is going to be like a new bubble. People have been comparing AI to the .com boom bust cycle for a long time now, and I've always kind of disregarded it. But the more and more of these deals that we see popping up, the more hesitant I'll be, with my allocations. I keep looking at my portfolio. Everybody knows I'm highly overweight technology, Nvidia, Broadcom. These are my two largest positions. So I'm definitely long this kind of AI semiconductor trade, up 1,000% on both of those positions. At a certain point, I'm going to consider trimming, but I don't know. Brad used the word froth when we were on the phone earlier, frothiness. I think that's probably where we are. I don't think we're at a huge, blowout bubble, scary valuation. But if these 28% daily moves keep happening every time a deal's announced, you got to wonder what's going on here behind the scenes. So, but thankfully, we're not mentioning Nvidia or AMD today in our picks. People know I like Nvidia. They're way up, in the last 3 months or so. So I think they're above fair value today. I think the idea is to give actionable ideas today. Everybody knows I love Microsoft, I love Broadcom, et cetera, but I think those stocks are expensive. So I'm going to talk about some tech stocks that I like, some hardware, software stuff, and I think Brad's going to talk about data centers because, as he said, obviously all of these major moves we're seeing are just powering this massive data center build out that we're seeing across the U.S. and across the world. So, a lot of green ahead in that industry, I think. But Brad, unless you have anything else to say, I can get started kind of on my picks. The idea was to provide three, of our top ideas today. So are you good to go or?
Yeah. I just want to say one last comment. I mean, I had a call this morning with a friend of mine who's a very big, I guess, crypto investor. And we had a friendly debate. We have these a lot, just talking about, crypto versus really what we do here at Wide Moat Research, whether it's technology companies or real estate companies or banks or home builders or asset managers. We really dive deep into the fundamentals of these companies, so we're not into market timing and all of that mess. I mean, we really like to look at fundamentals, and really we spend a lot of time researching individual companies to make sure there's a legitimate business plan. And a lot of these crypto deals that I'm seeing, just there's no fundamentals. And it's like Warren Buffett said. I told my friend this morning. I said, if you can't put that business model on one sheet of paper and identify what your investment strategy is and identify these moats, if there are any moats, then the company is not worth investing in or really considering. So these are companies that Nick and I both understand. We know them well, and hopefully this show today is of value to you. So Nick, I'll let you get started on your three tech trades.
Yeah, so I had a really hard time finding three that I loved. I mean, I think back in April, I could have given you, 23 that I loved. The market has shot up quite a bit in the last 6 months or so. So I'm going to give kind of a 3 honorable mention section and then 2 that I do really like today. So I'll get started with the honorable mention. First up, this isn't necessarily a true tech stock. I think it's more of a fintech play, but it's a company that anybody that follows dividend growth investing knows very well, and that's Automatic Data Processing, ticker symbol ADP. This is a dividend aristocrat. It's been paying dividends for decades and decades and decades. 2.1% yield here. And I'll throw up a fast graph. And as you can see, the stock's pulled back a little bit in the last month or so. It was up at 325 or so. Now it's down at 290. I sold my shares back in March. I was kind of trying to trim my portfolio position count down. And this was a relatively small position for me. I locked in, I think, 27% profits back in March at 306. And even though I do like the idea of cutting down the number of positions that I hold, it just makes my life easier. I also love the idea of buying back companies that I sell at lower prices. So I sold at 306. The company's at 290 right now. On the fast graph here, you can see this blue line is their long-term average, roughly 25 times earnings. 25 times forward is 277. As you can see here, this blue line, besides the COVID crash, ADP has bounced off of this thing every single time it's hit it for the last 12, 13 years. It's been a no-brainer trade. Obviously that the past doesn't predict the future, but when I have a support level like that, a decade plus long support level, the market does not want this stock to go down below that 25 times earning level. So if we hit that, if we get that kind of 277, 275 area, this is a company I do really like. I will re-enter. It's into payment processing. I think the stock's falling some because, we hear all this work about AI making a 3-day work week or really hurting entry-level jobs and all these recent college graduates being depressed because they can't find jobs because of, agentic agents and things like that taking over a lot of white collar positions. So I think that's the threat here. People are wondering what's a payment processor going to do if there are just a lot less jobs? And it's a decent question, but I've learned over the years when a company like this sells off, it's ignore the short-term threats and just buy the shares. It's worked out for me with this company several times and many others. So ADP, not going to get into it very deep here, but just watch that 275 level. That's certainly what I'm doing. If we get down to there, I will be a buyer of these shares again. So this is kind of a boring pick on this list, but this is something I know a lot of dividend growth investors will be familiar with. So I like starting it off. So ADP, honorable mention for me. Brad, any thoughts?
Now let's keep it moving. I like ADP, but I'm certainly want to know some.
There you go. All right, so we're going from overvalued to what I think fair valued. I go to Booking Holdings. I talk about this company on this channel a lot, so I'm not going to go deep into it. This is Booking.com and a bunch of other travel websites. You go in there, you book your trip. They've expanded airfare, boutique hotels, Airbnb type stuff, the whole gamut. This company, I saw an article in Seeking Alpha this morning, a news post talking about the stocks with the highest gains in the market over the last 20 years. And it was an Nvidia headline. Nvidia is the best stock in the S&P 500 during the last during the last 10, 15, and 20-year periods. So if you've owned Nvidia for 20 years, you're probably not watching this show because you're retired on an island somewhere. But I immediately went to that 20-year time period. I wanted to see, who's the best long-term holdings here. Nvidia first, Netflix second, Booking.com third in the last 20 years. These shares are up nearly 28,000%. So Booking has been such a great company for me. I've owned it for a couple of years now. I bought it during the COVID dip, and it's just doing what it does. This company compounds 15, 20% a year. I'll throw up a fast graph. As you can see, it's gone down from about $5,700 a share to $5,400 a share. So yes, I will mention this is a very expensive stock. For whatever reason, they don't split. Maybe they don't want options volatility, because to sell a contract on this company, you need, a lot of money. But you can buy partial shares at most brokerages. So that would be, I know I'm going to get a response. Nick, why are you talking about a $5,500 stock? I can't afford it, et cetera. Most U.S. brokerages for free offer fractional share trading. So that would be my response. But anyway, these shares have sold off, 6-7%. I think they're in line with the black line on the chart. They're in line with the blue line. And as you can see on a forward basis, this company is expected to grow 19% this year, 16% next year, 15% the year after that. If you buy and hold now, I think this stock's worth $7,000 a share in a couple of years, pretty conservatively. That's not, that's 24 times forward. So I like this company. Not a huge bargain here. I will put up the blue line here is the pink line, is roughly 20 times earnings. That's been this company's support post-COVID. We're still a long ways off from there. That would be a back up the truck type level, similar to ADP at that 25 times level. But even here at roughly 25 times earnings for Booking, I like the shares a lot. And then my last honorable mention, I'll be quick on this. Chuck and I talked about this a few weeks ago when we had Chuck Carnival on here doing our kind of value deep, masterclass episode. We talked about Fiserv. The stock had just sold off after earnings, and Chuck had said he loves this company. He loves the valuation. He did acknowledge, hey, it could go lower from here. At the time, it was trading for about $140 a share. Today, it's at $120, $125. So Chuck was right. It kept going low. But looking at this fast graph, this is the cheapest valuation this company's traded at since 2008. So you got to go back to the worst recession in recent memory to get shares this cheap. This is, once again, it's a payment processor. They do a lot of money moving between regional and small banks, and also kind of small and mid-sized businesses. I like the company. I mean, they sold off because they own Clover, which is a kind of a payments processing thing for small businesses. And that was their big growth engine. And then the payment volume is slowing with Clover in the recent quarter, but it's still positive. I think it's 8%. They're guiding roughly 10% growth. The shares are trading for 13 times earnings. They're expected to grow earnings at 15, 16% during the next 3 years. So it's a sub 1 PEG ratio play. Doesn't get much better than that. So this is once again, it's a fintech play. It's not a tech play, but I think I'd be remiss not to mention it here because this is a deep value. I got assigned some shares. I was trading this with options. It doesn't pay a dividend. So this is the type of options trades that I make because I use options to kind of create dividends out of thin air with these non-dividend paying companies. So I do own this company right now. I'm trying to get out of it. I've trying to get out with a wheel to just generate more income. But if I don't, I'm happy to hold it because I think it's very undervalued here. So, if you look at a fintech deeply valued, Microsoft, Visa, not Microsoft, MasterCard and Visa. Brad and I talk about these types of companies. They're very expensive, 25, 30 times earnings, different business models, but same area of the market. You're talking 13 times here. So I like Fiserv as a deep value play, but it's in the honorable mention because it does not pay a dividend. Brad, before we go on to the picks, anything to say about the 3 honorable mentions, or you want to keep going here?
Yeah. So let me say this. If it weren't for this one asset class that I'm going to talk about next, there would be no Nvidia, there would be no OpenAI, there would be none of those 3 picks, Nick, that you had. It requires one critical asset for all of those to work, which is what we're talking about today. Nick, what is that?
It's computing power.
Absolutely.
Is that where you're going? It's housed in the data centers.
We're talking about data centers. Now,
yep.
High level, for all those who may not be familiar with data centers, I was the author of REITs for Dummies, as well as The Intelligent REIT Investor. And I'm going to quote a couple lines within my book to talk a little bit about data centers at a high level. Data centers are very specialized real estate facilities that house computer servers and network equipment within a highly secure environment. They come complete with mechanical cooling, electrical power systems, and network connections. These data center REITs we're going to be talking about here, they own the building, the power and cooling infrastructure, and exchanges and cross connects. The customers provide their own servers, storage, and networking equipment. So a lot of these REITs we're going to be talking about, they haven't been around that long because they were, a couple of them were actually C corporations before they spun into REITs or completed from a C corp to a REIT, or IPO'd, I should say that, or converted to a REIT. So the first name we're going to talk about.
Hold on, Brad, before you go, I'm going to tee you up for your data centers, I promise you. But let me get to my final 2 picks. I don't want to keep people waiting. I think we got a little confused there, but data centers are great, important. And these are 2 stocks that use them. So let me get to my final 2 picks real quick, and then I'll shut up and you can talk about your data center REITs here. So real quick, Workday, they cloud computing, they do enterprise software. So yes, this entire business is based upon data center computing power. You can't have a Workday without massive data center and cloud infrastructure. This company I do like today really quickly. It's sold off quite a bit recently. It's trading for 28 times earnings, about 25 times forward. It's growing at 22 to 19% over the next 3 years. So this is a pick that I like today. I actually put on a trade this morning. So when Brad said, hey, let's talk about tech, I figured if I'm trading this stock, let's talk about this stock. So once again, no dividend yield. So what does that mean for Nick? It means I trade it with options. I don't just outright buy the stock because I always want everything that I'm doing to be generating income. So Workday, I like a lot here. The PEG ratio is pretty solid, 1.1, 1.2. So what I did this morning was, instead of buying the stock here at 235, which I like it in that area, I went and said, and I sold the November 21 $210 put, which means that if the stock goes down below 210, I have to buy it. But I really like it at 210. That's 20 times forward for a company growing at above 20%. So once again, that would be a negative peg. So what I did with this trade is I put myself in a situation where I get a really great value, similar to like a Fiserv, but with a faster growing company. I collected $279 per contract on that premium. So, relative to the $21,000 that those contracts are worth, that's a 1.33% yield. So this is an example of how I took a 0% yielding, high quality growth company and gave it a 1.3% yield. So I like that. It's roughly 15% annualized. If I don't get any shares, I'm okay with that too, right? I mean, I'll be sad if I don't get any Workday at 210. I'd love to own it there, but if I can get 15% yield on my cash, I'll take it. And just remember, when you trade options, that cash is generating roughly 4% just sitting there at Fidelity. So really, I'm talking 19% a year. So to me, win-win. I'll take 19% all day long. This company, when I was doing my research on it, Morningstar had said that, where's the quote here? I have it. We believe Workday is a front runner in the agentic artificial intelligence race. So they're going up against Salesforce. They're going up against ServiceNow. Morningstar thinks they're the winner. I think ServiceNow is a pretty strong player, and I own that share too. But The activists must agree, because Elliott Management just put $2 billion into Workday. That caused the stock to spike a little bit. It came back down. That's why I bought shares this morning, or that's why I traded those call options anyway. And the company has recently announced a $4 billion buyback. So not a dividend, but we do love shareholder returns here at Wide Moat Research. If they were to buy all those shares back at today's valuation, that'd be roughly 6% of the company. So love that. Like this company a lot. So Workday is one of my picks for technology stock that I like today. And the last will be one that I know everybody here has heard of, one that owns, massive data center assets, and it's Amazon. Very simple Mag 7 stock. This has been a laggard on the year. Amazon has not done very well. Let me look it up right here. On a year-to-date basis, I believe they're about flat. They may even be negative. They're up 0.5%. The market's up 13, 15%. Many of these Mag 7 stocks are up 25, 30%. So Amazon is a lagger in that regard. And if you look at this fast graph, you'll see the black line, which represents the share price, is getting deeper and deeper and deeper into the green line here, which are the company's profits. It used to be above it. There used to be a high premium on these shares. Now, Amazon's only trading for 17.5 times operating cash flow. You'll see the black line on the chart here. That is a level this company has moved at very consistently post-COVID. They're expected to grow 24% next year. So 17 times that 24% growth rate, we're talking $283 a share. That's pretty significant upside from today's kind of 220 level. So, people say, hey, TikTok's taken away the digital media. You've got the Trade Desk or AppLovin in that space. You've got Google and Oracle and Microsoft kind of taking cloud market share away. You've got Mercado Libre and Chinese AliExpress, et cetera, Walmart even competing in the e-commerce space. Sure, you can buy all 12 of those stocks I just mentioned, and you'd have a pretty diversified portfolio that, captures a lot of these growth markets. Or, like I do, you just own Amazon and you get a piece of all those buckets. Sure, and this has been the 800-pound gorilla in the room for over a decade now. And yes, people are trying to take its market share, but the company's still growing profits at 20% plus a year, trading for 17.5 time operational cash flows, like I said, and even on an earnings basis, less than 30 times forward earnings. It wasn't long ago this company's trading for 50, 60 times earnings. So the premium on Amazon has gone way down. Yes, the company's not growing at 50 to 100% a year. Now it's a 20% a year growth company, but I really like the valuation here. To me, in the tech space, in the Mag 7 space, if I had to pick one stock to buy today, it would be Amazon. So I'm done, Brad. Let's get into the data centers now. We gave them the viewers a little taste there. I just didn't want to upset anybody if they were waiting for my picks here. So I'm looking forward to your data center picks that kind of go alongside these software hardware names.
No, not at all. And Nick, great picks there. And it's always good to have as much content for our viewers as possible. And Amazon obviously is a hyperscaler that is a tenant of Digital Realty. Now, the first pick again, Digital Realty. This was the first data center REIT to complete an IPO, and that was in 2004. But as I mentioned earlier, they converted to a C Corp in January of 2014, which simply means they changed their tax status, where they previously they did not have to pay dividends as an ordinary C corporation, and they weren't as tax efficient. So now, by converting to a REIT, the company must pay out most of its taxable income to shareholders in the form of dividends, which is great for us REIT investors because we can now benefit from all of these rent checks, all of that income, like Amazon, that delivers to tenants and to Digital Realty customers in the form of dividends. Now, Digital Realty has around 300 data centers that serve 5,000 customers in 50 metros. They are one of the largest data center REITs in the world. So they certainly have scale advantage. They have most of their revenue concentrated in North America, around 52%, as well as Europe, which is about 29%, with additional exposure in Asia Pacific, around 10%, Latin America, around 5%, and Africa. I've got a map here. You can see kind of where they're scattered or where they have assets or data centers, literally all over the globe. So this is the fourth largest publicly traded U.S. REIT today with an enterprise value of $80 billion. So they certainly have that scale advantage. But what about their cost of capital advantage? Well, they also have a very solid balance sheet. They're BBB rated by Fitch and BBB plus by S&P, as well as Baa2 with Moody's. So very strong balance sheet. At the end of the second quarter, they had around $7 billion of liquidity with leverage at 5.1 times, which is below their target range, which is about 5.5 times. Now, arguably, the REIT conversion I mentioned earlier, it worked well for Digital Realty. I'm going to show you the benefit of converting from a REIT to a C Corp. So in 2014, and I've got a fast graphs here, you can see this. 2014, shares were trading at around $49 a share with a price to AFFO multiple of 13.4 times. And then you show on the right side of this chart, you can see shares are now trading at $176.35 with a price to AFFO multiple of 27.4 times. So since that spin, since the REIT conversion, shares have returned 13.5% annually since January 2014. So clearly that has worked. The data center REIT model clearly works. Now, digital has generated very attractive growth. I put another chart up here. I put these up a lot when I do these REITs. You can see their AFFO per share, which is growth has averaged around 5.1% since 2014. Not great. They've had some really good years, but I want to point this out, and this is really driven by the insatiable demand for this technology that we're talking about, that Nick, you were talking about earlier. You can see analysts are forecasting growth of 8% in 2026 and 10% growth in 2027. So definitely like this company. Now, some of you who follow me and have followed me for years on Seeking Alpha may know that I recommended Digital Realty quite a bit in the past. In fact, I had a strong buy rating on the company in 2013 when there was an activist by the name of Highfields Capital that decided to short the company. Now, I want to point out that I did a lot of follow-up articles on Seeking Alpha over that time, but since that time, when I wrote that article, really debunking Highfields, shares have returned 13%. There's also another article in October 2022 I wrote called Digital Realty, Chanos Big Short equals Big Buying Opportunity. Now, of course, I'm referring to Jim Chanos. Hopefully I got his name correct. We've had some Twitter exchanges going back and forth, or X exchanges, when he was short the position. I don't think he's short the position now. I haven't checked. Hopefully he is, because since I debunked that article, shares have surged to 20% or 25% annualized. So that's what I like to do. And really, not me, but Wide Moat Research, we like to find these companies like Digital Realty, have very strong fundamentals, and we buy them when they're beaten down, like they were when I wrote the article debunking Chanos. Now, so Digital Realty today is really fairly valued. I would wait on a pullback currently because I'm going to tell you about the next play. The next play we like a lot better, which Nick's very familiar with our Wide Moat letter. It's called Equinix, ticker is EQIX. This is another pure play data center REIT. Company also went public in August 2010. And just like Digital, they converted to a REIT in 2015. Let's go back and see what happened with that REIT conversion. As you can see here, shares were trading back then at about $216 per share with a price to AFFO around 16 times. Now, fast forward to today, shares are trading at $778.74 with a price to AFFO multiple of 20.87 times. So certainly, I think that generates something around a 12, 13% average return. Now, Equinix operates 272 data centers, or about 34 million square feet, in 76 markets and 36 countries. So obviously, very much covered very much globally. You can see the picture of all their properties, the locations. They have 492,000 interconnections, and 96% of that is renewable energy coverage as well. Now, they got the scale advantage just like Digital. Also, in terms of the balance sheet, very strong ratings, triple B with Moody's and S&P. And the company has $8.5 billion of liquidity at the end of the second quarter. Again, net leverage ratio of about 3.5 times. So very comparable in terms of the balance sheet. But what I want to show you what's different, and this next chart really highlights their earnings growth, especially compared to what I just showed you previously with Digital Realty. You can see this particular chart, which shows their AFFO per share, shows a consistent growth of earnings. This company has averaged about 2.8%, almost 11% growth, again, since they converted to a REIT in 2015. In addition, analysts are forecasting very solid double-digit growth. You can see that that's the lighter blue line there on the chart, 2026 and 2027. So double-digit growth. They've consistently maintained double-digit growth, and they're cheap. You can see here, this is a fast graph. Shares are trading at 20.8 times compared with their normal valuation at 24 times. So you can see that identifiable margin of safety here in terms of their valuation. And again, in terms of their growth forecast, actually, I was wrong. The growth forecast is 6% in 26, not double digit, 8% in 28, still solid. And based upon the growth forecast, the current dividend yield, as well as the price, the valuation, we think this company could achieve annual returns of around 20% over the next, annually 12 months. Now, also, many of our YouTube subscribers have asked me to talk about Iron Mountain. That's ticker IRM. This is another storage REIT, but not all in, pure play, I guess we'll call it, self-storage. Now, this company, they converted from a C Corp, again, to a REIT back in January 2014. We actually covered Iron Mountain when they were a C Corp and watched them convert to that C Corp over time. Now, the company owns around 30 data centers. The bulk of its revenue, though, as mentioned, is derived from document storage and their record management business. They've been adding more investments into the data center space. As I mentioned, there's 30 data centers today. Since they converted to a REIT, again, going back to be consistent with the others, Iron Mountain has returned around 12% annually. This is a fast graph here showing their annualized returns since they converted. So all of these REIT conversions have worked well. Now, currently, Iron Mountain is trading about 21.2 times, which is below or actually above their normal valuation, which is about 13.3 times. So definitely a little pricey today based on their normal valuation. However, they have expanded more recently into data centers. So certainly the valuation could be somewhere, I would wait on a pullback, something like $100 a share today, maybe closer in line with maybe a 18 or 19 multiple for Iron Mountain. Last but not least, I want to mention to you, I've shown this chart in previous shows before. This shows all of it looks like a Rubik's Cube. I know it's a lot of different colors, but this shows all of the different property sectors, traditional property sectors, office, industrial, healthcare, hotels. But then again, we can see on the very far right in 2015, where the data center REITs started to convert, or data center companies converted to REITs, you can see how they've performed really over the last decade. And what I want to point out is over the last 10 years or so, the data center REITs have outperformed all of the other property sectors. And obviously in the last 2 years, we've seen significant overperformance in terms of, in 2024, the company generated around 20%, 25% total returns. In 2023, the data center REITs generated around 20% total return. So beating all of the other property sectors. And last but not least, there's been quite a bit of M&A activity. I mean, we have 2 pure play data center REITs. We also have the Iron Mountain. Several other REITs have invested, publicly traded REITs have invested into data centers. For example, American Tower purchased a company called CoreSite with about 25 data centers, which is now part of, obviously, the American Tower business model, which is predominantly cell towers. Then another company we covered, QTC Realty, was picked off by Blackstone for around $10 billion. And then another company we covered once upon a time, CyrusOne, was purchased by KKR and Global Infrastructure Partners for $15 billion. So we certainly see some transactional activity. And again, we're looking to see more data center REIT coverage. We had one last week announced, and we wrote about it in the Wide Moat letter, called Fermi, which is amazing that you have a data center that listed last week that generated something close to $17 billion in market capitalization with one company, which really has no assets. All they have is just land. They haven't even built this building yet, but the market reaction was crazy. And again, that shows to this frothiness, Nick, that you and I were talking about earlier. We certainly see that. And that's why we're covering this sector in great detail, to really drill down to understand the fundamentals, the drivers for both the technology companies as well as the data center REITs.
Yeah, so I guess a couple things. One, kudos to you and everybody else that is long Iron Mountain. I have been a skeptic, probably to say the least, in the past. I remember back during the COVID sell-off, this company had a double-digit dividend yield. I think you were pounding the table, and I wasn't sure that they'd be able to just quickly kind of pivot into the data center space. Before, they own literally a mountain with a cave in it that they store documents in, and that's their business model. I obviously didn't like that kind of as we continue to transition into the 21st century. But man, they've done a great job. They've done they went from yielding 10% to yielding 3%, and that was not because of a dividend cut. That's because of massive share price appreciation. So anybody that bought that stock, 5-10 years ago when you first started covering it has done very well. Wish I would have followed your advice. I didn't. My question, I guess, regarding the rest of these companies is, why do you think DLR has such a premium valuation compared to Equinix and Iron Mountain? Because Iron Mountain and Equinix are about the same spot, roughly 20 times forwards, 18, 19 maybe, if you look at Iron Mountain's growth, which actually is the fastest growing of the three. So once again, kudos to you. I didn't even realize that. So they're projecting 12% growth next year for Iron Mountain and in 2027. So that company looks really solid here. It is hard to evaluate because, like you said, they're trading well above their long-term average, but it's a totally different company today than it was 10 years ago. So I don't know that the long-term price to, adjusted funds from operations really matters all that much for Iron Mountain, because they're trying to become like not a pure play data center REIT, but they're trying to transition from old storage into new storage. But with Equinix and DLR, they're pretty similar business models, pretty similar portfolios, pretty similar balance sheets, et cetera. One trades for 27 times DLR, one trades for 20 times Equinix. Why do you think that is?
Well, I'm going to give you a really easy answer, and it's one word. It's management. We followed all these companies. I have really since they were even C corps and converted over, and so we've seen this evolution. And Digital's had several different CEOs turns over the years. The current CEO is doing a great job. The current management team is doing a great job. And I would just say, management boils down to managing their capital stack and managing their tenant base. And in terms of their balance sheet, they've done a really good job of recycling properties. They also have these joint venture partnerships with many of these private equity firms like Blackstone. They also have joint venture partnerships with REITs like Realty Income. So they've got a very flexible balance sheet, which obviously makes investors really glad. There's a lot of clarity over execution. They've got a prized tenant base with a global footprint. So again, some of those parts is really management. Management's done a good job. Equinix, again, decent management team. They've also had some short interest in the stock. I think it was last year, they had a fairly large activist pursuing Equinix. And so that has obviously been a reason that shares have sold off. However, again, you could see the chart and what I showed you earlier, the fundamentals. Equinix actually has better fundamentals from a free cash flow perspective, AFFO per share, and they've been able to grow much more consistently. So that's why I really believe Equinix is a better buy today. I like Digital, and obviously, we picked it off at the right time. Both of those activists who went after Digital, obviously, we pounced on that. In fact, even the very first, I remember in Highfields, the very first activist went after the company. I think it was 2015 or 14. They didn't really even understand the whole concept of how REITs are priced. They were looking at the PE ratios, et cetera. And we even saw that with Jim Chanos with his short position. I think it was last year where he and I had some friendly debate all over that subject. I offered to send him in the REIT for Dummies book because he didn't really understand how to value REITs. And then we use these less traditional earnings metrics. So I think a lot of that is people don't really understand data centers. And that's what we're here to do here at Wide Moat Research, is to help you understand, how data centers operate. Nick, it's great to have you on the show because we can understand those driving forces behind these customers like Amazon. So look, I think it's frothy, but I think there's some great opportunities. And Nick, I'm glad you've got overweight positions in technology. Kudos to you. And I hope this video is helpful to our audience today. We want to keep you informed with all of our investments, and that's what we're here for.
Yeah. I hope you guys enjoyed this one. Like we always say, please like and subscribe to the video and channel, and we'll see you guys next Thursday. We're not sure what the topic will be, but we'll do our best to find something actionable, insightful, and entertaining, and we'll see you guys next week.
Hi, everyone. Thank you for watching today's episode of the Wide Moat Show. Please comment, like, and subscribe below. or go visit us at widemoatdaily.com. As always, happy swan, sleep well at night investing.